good afternoon, good morning, depending on where you are. It's Don Hart, Vice President of Training Development at the IDC World Source Insurance Network. We've got an exciting presentation today. I was just saying to Norm, it's got to be more interesting than Netflix. So think of the best movie that you've seen on Netflix recently, Norm's going to be better. Just spent a few minutes talking with Norm LeBlond, and he's with Sun Life. He's the underwriting director, I think, over the chief underwriter and claims risk officer at Sun Life. Took a look through his slides today. We're going to go right under the hood to discover the underwriting decisions of Sun Life and the changes that have happened as a result of the last few years that we've experienced. But I want to start off just by introducing Norm's bio here. Norm thrives on the challenge of applying innovative problem-solving skills and driving for results and differentiation. Throughout his career, he has sought to promote engagement and collaboration to better the underwriting community, which is evident through the years of service to the Association of Home Office Underwriters, of which there's, I think you said 900, was it 900 members?
Yes, about 900
members throughout the US and 20% in Canada. So he is also a member of the Academy of Life Underwriters, Canadian Institute of Underwriters, and in 2019, Norm was inductee into the Association of Home Office Underwriters Hall of Fame. So we're going to hear his claim to fame in a few minutes. Norm received his Bachelor's of Science degree from the University of Waterloo, where I spent 20 years, Norm, just so you know, and began his underwriting career over 26 years ago after spending 5 years with Swiss Re, Canada's chief underwriter, Swiss Re Reinsurance, obviously, as the chief underwriter. He rejoined Sun Life in November 2019 in the role of VP, Chief Underwriter and Claims Risk Officer. I know you're going to enjoy today's webinar. We want to make sure that you realize the chat line is open for Q&A, or then the Q&A is open as well. So if you have some questions, feel free to ask those questions. Norm is obviously the guy to ask those questions of, and without any further ado, Norm, I'm going to hand it over to you.
Awesome. Thanks, Don. I appreciate it. So, and thanks for having me. I'm really excited to be here, and I will share my insights on the environment. So if you go to the next slide, covering a lot of topics, and some hot topics. I'll give you my insights on the current environment, things that are changing. And I can tell you that first of all, COVID has really accelerated the move towards digital solutions and non-face-to-face and everything like that. The movement was already happening, but the pace of change is happening just so much more quickly now. And Don and I were just chatting. We're even open to things now that we seemed we weren't open to before, which is just an interesting environment that we're working in. So I'll cover some hot topics. Underwriting 201 is just to say that I'll focus a little bit on some of the more complex or high net worth cases and the diligence maybe that goes into some of those cases. I will give you some insight on the reinsurance world and more importantly, how we interact with the reinsurers. So that'll give you some information on. I'll touch financial underwriting. I'll give you some insights, I guess, on what we look for, why we do what we do, and then I also focus on one of the big things this you'll hear throughout is finding solutions. Right? I think we're challenging the status quo, and it's important that we do that. So when we go through financial underwriting, I'll give you some insights there. I will cover some future of underwriting topics, hot topics that are happening now, both on the medical and non-medical side of underwriting. And then I like to wrap things off with kind of my top 10 of things. We'll leave a lot of time for Q&A if we have questions to answer. Try to make it a little interactive towards the end. So moving to the next slide, like I said, kind of some hot topics. For me, one of the things is a lot more underwriting flexibility, generally speaking. We'll talk about less requirements. The key to doing all of it is innovating while maintaining our existing product and pricing structures, replacing actual and known protective value of evidence we've obtained for decades, leveraging data and accelerating the use of, when we talk a lot about advanced analytics, that's certainly true for accelerated underwriting and what we've done with our requirements to reduce the invasive requirements that we've had over the years. The key to all of it is digital data, right? So I think, and some of it is not innovative at all, like improving our e-apps, which is interesting because we finally introduced the e-app right, to the independent channel last year. We've had an e-app for 20 plus years. So taking a paper app, making it electronic, that's not innovation, right? So I'll talk a little bit about that. Increase the use of things like tele-interviews. It's really about reflexive questions, right? So whether it's through the e-app or tele-interviews, it all gives data. And we have a lot of data historically. So it's, what we do is we look at that data, we look at trends, we look at how we can make changes using our own data and forms of data that we'll be getting over time to enable us to expand the use of accelerated underwriting and to promote alternate ways to assess risk or to be more comfortable assessing risk, because data makes you more comfortable if you can kind of wrap your head around what you're seeing. So more reliance on data to drive decision making. And like I said, the trick is to evolve in real time. So manage the same level of risk, or better yet, how we get to the real or actual risks more quickly. I think that's the key for me. It's also important to understand market differences. I just mentioned this briefly because when we talk about accelerated underwriting, as Canadians, we're implementing changes without having access to things like prescription data or alternate data sources that our US counterparts have, electronic health records and everything else. But we're still making changes. It just shows that you can do it. It's just you'd need to do it differently. You have to approach it slightly differently. So that's the environment we kind of work in. So for underwriting requirements and accelerated underwriting, we all want quick, real-time decisions. That's what we're working towards. The rate of fully automated, processes continues to increase. We're striving towards that real-time decision. The other thing that I like to say is, it's funny. We work in an environment where historically we've worked with charts, right? We know that here's the agent amount requirements. Here's what you can expect. I know we're moving to an environment where that's not the reality all the time, and we're asking you to trust us as we work through it. I know I know that can be a challenge, but from my perspective, I look at it and I say, why are we underwriting a 40-year-old closer to a teenager than we do someone who's 41 or 42? That makes no sense to me, right? So we're trying to blur those lines a little bit and get to risk assessment where it really matters. So the goal, look for ways to reduce complex time and cost of traditional insurance underwriting requirements without degrading mortality risk assessments or experience, right? So the price of our risks. You can underwrite simply, but the price is really high. We fully underwrite lowest possible price. What we're trying to do is still maintain this while reduce the requirements, right? So that's what we're trying to do. Simple. But digital data is used to, what I would say is it's used to eliminate labs that would otherwise be required. So when you think of accelerated underwriting, and I know this is the challenge at times is to understand or to trust us, we're taking cells that 100% of the time we asked for tests to get at, in some cases, 2.9, 7.1% of risks in that cell. What we're trying to do is say, let's not test 100% to it. How can we get comfortable testing half? And then through more data, continue to refine that to get closer to that, to the risks that really matter. So that's kind of the evolution, trying to eliminate blood, urine, vitals, underwrite the risk differently, and maintain the same cost. And so when we say underwrite differently, a lot of it is through data. A lot of it is through using e-apps, tele-interviews, because of the reflexive questions. You can target what we think is important and get value in the data that we're getting. So that's, kind of the environment that we're working through. So for, I know we went out, we're testing limits. We've gone up to 5 million, up to age 40. Like other carriers, we've gone up to age 60 now with accelerated underwriting. Start slow, test, learn. That's the cycle that we're in, and it is a cycle. And I know the cycle is moving quickly, but we will start at younger ages, smaller face amounts. We will test a higher percentage at the start until we're comfortable the models are working as we expect them to, which we're already, we introduced accelerated underwriting at the end of 2019. We're already in a third iteration through COVID. And so that tells you that what we're seeing makes sense. And so we're going to continue to evolve. So that's the environment, continuous improvement. So it is about leveraging data. Predictive analytics helps us get there. We're trying to get to 76% of life applications without the need for labs. We were at 47% just a couple of years ago. The interesting thing, if you think of critical illness, which when you look at the products, critical illness, some of those factors, whether it's blood pressure, build, blood sugars and everything else, more significant for critical illness insurance. And yet 90% of that business goes through without labs, right? Again, there's a cost thing. With life insurance, especially with preferred rates, that's driven the rates down. It is a tougher sell, I guess, or a tougher business case to try to get those values up while maintaining the prices that we've always had in the market. One of the things we always look for is not to increase the price significantly, because then you're out of market. So you can make changes, but if you're out of market and pricing, you're not in the game, right? So those are all the discussions we have internally on the evolution of kind of accelerated underwriting and the requirements. Underwriting, I mentioned claims, but mostly underwriting guidelines, philosophies. Through all of this, we are changing the way underwriters are handling cases, proactively looking to find solutions. We talk a lot about the future of underwriting. As we automate more, as we request less requirements, the roles and skills of the underwriters will shift from being transactional to be more solution and relationship driven, which will serve you better on those cases where that's necessary to kind of help move things along. From an underwriting perspective, we have guidelines. They're on a piece of paper in black and white, but they're not black and white rules. If they were black and white, we can automate it. And that's what we're working towards, right? With the underwriting rules engine, we can automate it. If you can ask the questions, automate it, you do that. The more we understand the risk, the easier it is to make the right decisions and find solutions. So where it's not black and white and it's more gray, can we, without asking hundreds of questions, can we get at that risk quickly by asking pointed questions that get at most of the risk, right? That's the evolution of kind of our guidelines as we see it. It's also challenging the way we handle cases. And I'll give you an example. Mental health was an important initiative we kicked off last year that best highlights this. To address the challenges of underwriting mental illness for the purposes of insurance, we initiated a campaign to help increase awareness of mental health issues and improve our decisions, and more importantly, the handling of cases. We were declining too many cases. We were getting doctor's reports in too many cases when all you need to do is understand what's going on. So ask questions differently and trust the information you have more often than we have, right? So, and one of the things we talked about a lot is underwrite the person, not the condition. Someone could be off work for a period of time. It doesn't mean that it's a severe condition, right? But the definition of severe sometimes is someone who can't work or can't function in their normal duties or whatever. So, but sometimes time off doesn't necessarily mean can't function, right? So it's that type of nuance that we try to work through as underwriters and say, let's not go to the most conservative way. Let's try to find solutions, right? So, through all of it, I know I talked to a lot of advisors and even some clients. I was surprised actually to hear how many would not submit cases with mental health histories because of the incorrect perception or maybe even a bad experience in the past on mental health cases. So I can tell you that most cases are insurable and many with standard rates. So just one example of trying to find solutions in underwriting. I mentioned the role of the underwriter changing. Underwriting is the most resource intensive and time consuming new business acquisition cost. So it's not surprising to see that that's where the efforts are to try to improve the processes. I mentioned the role of the underwriters changing. Today, case underwriting, responsible for individual risks. Tomorrow, optimizing this rule set that I've talked about, right? So the bigger picture of how we can optimize what we're seeing on a broader scale and push things down a little bit. Thinking about innovation, new approaches to underwriting, new data sources. So the skills will be different. There'll be data analysts, portfolio managers, relationship builders, and consultants, right? So that's the environment that we're kind of working towards for underwriting. COVID-19, I'll touch upon briefly. Probably a topic in of itself. It's certainly changed the landscape for us. It's made us, like I said, move more quickly with things. We and a lot of people, a lot of companies in the market introduced temporary measures that are now becoming permanent. A lot more comfortable with non-face-to-face than we have ever been in the past. I think it's pushed all of us to kind of accept this new reality. So Through it all, I would say that we maintained, from an underwriting perspective, the long-term view of risks. So for COVID, we did not change, for example, our foreign travel guidelines, because I felt very strongly that foreign travel is not where we're seeing risk. Sure, there were risks globally, and if you talk to our reinsurance partners, they were a lot more exposed to this, for sure, because they see business in all the markets. For Canada, I think it was about mitigating the risks, or not overreacting to the risks. That's how I like to say it. We have long-term view of risks, long risk products. Let's not overreact to the environment. So we didn't change our foreign travel guidelines. That in and of itself is not where there was risk. Your neighbor could be a higher risk, even though they weren't traveling. So we did not reduce our retention, even at older ages, or when there was increased risk. So just things that we did or didn't do during COVID is not to overreact to the environment. From an underwriting perspective, COVID-19 is a viral illness. If the virus is present, or if someone's in isolation, we would defer for 14 days, maybe 30 days if there were symptoms. If there were complications, hospitalization, or a more severe condition, maybe up to 6 to 12 months. In those cases, it's really on a case-by-case basis, and we haven't seen a lot of them that have been that severe. But then it just becomes a situation of, like we would for any other viral illness, underwriting it based on any complications, and this would be true for viral illnesses or any other condition. You just underwrite for what that person presents at that time. So I will say it's probably too soon to fully understand what permanent changes we in the industry may need to make to whether it's our guidelines or application questions or our requirements. There's no signs that anything needs to change at this point, but we do need to be very diligent to understand what long-term impacts could there be. We hear about long COVID. All the data we've seen and a lot of conversations we've had have shown that there's nothing imminent to it. There's a lot, but our current environment is also different than a normal environment too, right? Everyone's isolated. Does that have an impact on mental health or people's ability to recuperate from some of these? Is it right? So is it long COVID? Is it something else, right? So those are the conversations we had. Nothing to report at this point. We don't anticipate any significant changes, but something worth monitoring. The other thing I just mentioned on COVID before we move on to another topic is some of you may have had questions. I know there's been a lot of activity, social media in particular. It's hard to combat what you see in social media sometimes, but there was some data or some information in social media that was incorrect or inaccurate. I will just say that there were no changes in our claims policies because of COVID-19 or receiving the vaccine. That's the one that caused a lot of stir. So I just wanted to reassure you in case you haven't heard. But COVID-19 or any viral illness for that matter, or their vaccines will not impact our ability to pay claims. We are paying claims. So I just wanted to mention that. So if we go to the next slide, just in terms of underwriting, just generally speaking, you can see here, medical, financial, retention are things that matter more on the more complex cases, whether it's high net worth or where there's significant risk. So I think it's just a matter of understanding the landscape. This is more about just positioning cases. On the medical side, it will require more diligence. We're dotting our I's, we're crossing our T's more on some of these cases. That means full medical review. We are going to ask for complete records for the past 5 years on high net worth business in particular. On the financial side, we will confirm things through third parties. There's an opportunity there to make some changes, but I'll talk about financial underwriting in a couple slides. And retention. I'll just mention here that our retention is based on the net amount at risk, so that includes growth, because we need to hold reserves for that amount. So when we look at a case and it's 10 growing up to 15, we reserve or we retain based on the net amount at risk, so the full amount, the 15 million. And age, mortality, other risk factors kind of play into that. And I'll talk about that in a minute as well. So maybe just move to the next slide. I'll talk about reinsurance a little bit. So coming from the reinsurance environment, I got to see that side of things, and now working with the reinsurers. Obviously, the reason that we and every direct company uses reinsurance, you can see here, there's a lot of good reasons for it. It is about sharing in the risk. Right, it allows us for a large case to be able to get the expertise from all the different companies, and everyone's going in together. I think that gives a lot of comfort to it. It does allow us to have more capacity, certainly, because we can only retain so much, although we can retain a lot. There are some times where we just need to leverage our reinsurers to help us get capacity. It does improve our pricing and profitability. It does help us manage risks, whether it's new products, and that's something that could happen. Right now, we're talking, a lot of the discussion about new products would be around, I know Manulife has vitality, but we're talking a lot about, is there something in a product where you can do continuous underwriting, and not full continuous underwriting, but just, is there something there broader than just an engagement platform, right? It's not about that. It's about just something broader. Managing financial risks also with large claims. If a claim goes over a certain amount, our reinsurers participate in that. They give us their expertise, so that helps. And of course, the last bullet, just with the experience. The one thing I will say about that last bullet is, coming from the reinsurance environment, there's a lot of there are a lot of benefits to using reinsurers. One of the things we've done a lot is, as a direct company, we ask you at times to provide cover letters. And what that does is it tells us, tell us the story. I mean, the client. It doesn't come across on black and white paper or through an application the way it would intend to do. The cover letter helps tell the story, position things that are nuances or things that are not apparent to us. What we do is the same thing with the reinsurers. We take all of the information, we apply what we are comfortable accepting with it, and then we position it with the reinsurers. So one of the challenges that we've been working through is, it's not we're not sending cases to our reinsurers asking them to re-underwrite it. The reason we want to package it is because we're asking them to support what we think, or to challenge us if they think we're off base. We're not asking them to re-underwrite it, because what we don't want is, us and 6 or 7 other companies all coming up with different conclusions and trying to wrap your heads around how you're going to manage this, right? So we try to take when I say finding solutions, we try to use our guidelines, which of course that drives our corporate philosophy of what we're comfortable risk-wise. But we also know what the market does, and we also know where there's opportunities. So leverage that, package the case, and then ask your reinsurers to support that. So just a little bit of information on how that works. Just the one last point on this one is just the complexity of the reinsurance environment sometimes, in that sometimes a reinsurer has a reinsurer themselves, right? So direct company, and 6 or 7 reinsurers, 3 or 4 of them could have another reinsurer. So you've got like 10 or more companies sometimes looking at a case for some of this really high net worth case. It just adds complexity to the environment. So the next slide, I'll just talk a little bit more about each of these. You may know this, and it may be a repeat for some of you, but obviously we want to maximize market capacity where we need to. Every company has automatic binding limits. And so what that means is, and I'll give you just an example, a $40 million, SunPar case, we can accept that and bind our reinsurers to it, meaning we have the pen to make the decision on that case. If it goes above that, then you have to go to the reinsurance market. So that's the automatic binding limit. Then every company also has jumbo limits. So what that is, let's use that same $40 million. If you're shopping a $40 million with us and another company, that's 80 million in the market. That's where the jumbo limit comes into play. The jumbo limit is everything in force and applied for in the market. So all of a sudden it's 80 million. So even though I could on a $40 million case accept it myself and auto bind the pool, if it exceeds the jumbo limit, I and every other company is going out to all the reinsurers for them to review those cases. So that's just how the environment works. And then of course, we do use the last bullet here is we do use reinsurers for better offers. There are times where they are more aggressive and can be because of their exposure, their experience. We leverage them in those situations as well. Retention. I will say that we have a large retention and we use it. I mentioned that we didn't reduce it during COVID because we have confidence that in the underwriting, in the long-term view of risks, our retention, I'll tell you, is can be up to 40 million depending on the situation. 25 million for sure. We have an extra that we can tap into. We used it a lot during COVID. I can tell you I think one of the questions in leading up to what I would talk about here was did the reinsurers reduce their capacity during COVID? And the answer is absolutely they did. It came and went. Some reacted really quick. They reduced their capacity in half. We didn't. We kept it. It did impact some of the cases where we were high net worth cases, of course, where we had what we thought was a firm offer or a tentative offer on a large case, and then we were like less than half in some cases on some of those cases, and we were still maintaining our full retention. But the reinsurance environment it is different. They're in a global market. So you know what was happening elsewhere in the world that maybe was more heightened awareness impacted the reinsurers more than it did for sure us. And they also have a lot of other things that they need to worry about from a risk management perspective because they're not in operations. They don't see some of the other benefits that we do as a direct company. So all that to say that there was an impact. Some have come back, maybe not all the way yet, but certainly we're on the road back to recovery to where things used to be pre-COVID. Retention is reduced, and this is true for capacity as well, usually reduced at younger ages, certainly under age at 2, older ages, over age 70 in particular, and then when there's increased mortality or special risks like aviation, athletes. We don't see a lot of professional athletes on the large scale, so that doesn't come into play, but our retention is decreased in some of those situations. There are 7 reinsurers that we deal with in the Canadian market. There's one other as well. They all have their own retention and capacity, so that what I just talked about, all the different limits and what everyone has the same things, same things. So just an environment to work through. So when you're shopping a case to multiple carriers and everyone's going out to market, it does get complex. Thought I would just mention that in passing. So maybe just move to the next slide. Talk a little bit about financial underwriting. And again, some of this you may know already, but if I just give an idea, the first 2 bullets here mean the most to me. First of all, is obviously when we're financial underwriting, we're making sure that we're protecting against loss, an actual loss or a proposed loss. We're projecting into the future, of course. And we are looking against anti-selection. Is there a reason that someone would apply for this coverage where they may not otherwise, or are they selecting against? I mean, that's something that an underwriter needs to look at. It doesn't guide our actions all the time, but it is something that we need to mitigate. Fraudulent claims, we need to just make sure that we're protecting ourselves against that. You don't think of that too often, but it is what guides our actions on financial underwriting. Managing affordability controls, it's always been there. I think the last couple of years, it's just been heightened a little bit more because of the product structures and some of the challenges to use insurance as an asset class more frequently now or differently than maybe what we've seen in the past, which is all acceptable. It's just managing those controls makes complete sense in some markets and then for some clients, and others you're looking at it and you're saying, I just don't get it, right? And so that leads into the next 2 bullets. I mean, if you're going to put something on the books that, first of all, won't stay in force for very long, why bother? But also, and we're starting to see this a little bit, where people will come back 2-3 years later and say, I don't know why you sold me this. It doesn't make sense to me now, right? So reputationally, you don't want to get into too many situations where you're overexposing yourself to that type of risk. So just the things that kind of go into our minds when we're looking at financial underwriting. So the next slide, I think one of the things that we look at when we're financial underwriting is affordability, looking at the big picture. We always ask ourselves, does it make sense? And often the answer is yes. It's just how do you get there? And what do you need to get in order to be comfortable getting to where you're able to accept that case, right? I mentioned insurance as an asset class. That's something that is acceptable. You can use the insurance, or you can use traditional insurance, whether it's income replacement, a person's net worth. Even if the basis for the insurance is an asset, you're still using life insurance, the traditional life insurance as we know it, projections to get us the insurance coverage in place. So just an interesting, so affordability, those are things we're talking about, we have covered, but as long as we're able to answer the question, does it make sense? Often you can accept, those, many of those cases that you're going through. So I think one of the challenges is setting the right guidelines in place that apply broadly. So we could say we want third-party verification through 2 years of financial statements, but what is the right level of information? Because that's a guideline. It doesn't apply broadly to everyone. Sometimes some of these structures that are in place are very complex. I've seen some cases where I'm not kidding, summarizing a case was like 10 pages long. I couldn't believe it. And so how do you get comfortable understanding the landscape, and not thinking that you need 2 years of financial statements for 12 companies, just as an example, to get there? So how do you get comfortable with some information, enough information, certainly for this really high net worth business? When I talk about us packaging the case and shipping it, or giving a recommendation to the reinsurers, one thing we don't want to do is just say, well, we'll get this information and just throw it over the fence and see what comes back. Because then you get into trouble, because then you get different philosophies, and I will tell you that sometimes a lot more conservative than what we would expect coming back at us. So because we've spent a lot of time on this business and understanding it, our job is to kind of explain that to the reinsurers, right? And we have workshops with them to go through the new concepts that we're working through and why we're doing what we're doing. And I'll give you one example that highlights this. There's a new reinsurer that entered the Canadian market last year. We started doing business with them. They've got a lot of global exposure. I've known a lot of the people that, in this company. Great company, great risk management, but when they started looking at our business, they're saying, you guys do things differently there. Like nowhere else in the world is doing it this way. So we're going to change the way your market works. And I'm thinking, no, you're not going to, you're going to change to our market, not vice versa, right? So, but that takes time. And so you need to go through how we got comfortable with the products we have, the growth, using insurance as an asset class. And just interesting, just gives you a little bit of insight at the landscape with financial underwriting and the reinsurers. So maybe go to the next slide. Maybe the one after this. I think I've covered all of these. Thought I would just cover a couple of really hot topics that are happening in the market now. Obesity and diabetes, worldwide problem, has been for years. There is obviously a lot of correlation between diabetes and excess mortality and morbidity. I think that's pretty well known. What can we do as an insurance company to offer coverage and improve the client journey through wellness and engagement platforms? We've talked about it. This is where I mentioned earlier that, is there a product structure that a different product that's not the traditional product, that if it doesn't qualify in the traditional product, is there something else we can offer that's just different, right? That offers you something now with the ability to go back to a traditional product. So anyways, it just gives you an idea of some of the conversations which we're having. Diabetes for Sun Life is one of our key initiatives, is to improve the experience for diabetics in Canada broadly, right? So we want to make sure that we have these conversations and we look for opportunities to improve that. I can tell you that for obesity, from an underwriting perspective, I think our guidelines are market leading. We underwrite obesity very good. I won't say aggressive, because it's not about being aggressive. It's about coming up with a philosophy that we're comfortable with and we think makes sense for the environment. So, so for life and critical illness, I think we're very good. For diabetes, guidelines are pretty consistent across the industry. And we recently did a study on our mortality experience. And I can tell you that it's been pretty well bang on. over the years. Our mortality experience, the study that we did was based on policies that were issued over 20 years ago. So it's been enforced for a long time. And we were able to look at it, and certainly our experience in the first 10 years of the policy was good. And as you would expect after that, it kind of creeps up. But it's interesting to say that our guidelines, I think, are accurate, because that's one of the things we talk about. Are we being too conservative with diabetics? Generally speaking, the answer is no, because what we're seeing is accurate. We just need a product that can help us, right? So the first 10 years are good. After that, it kind of goes up. Do we get a product that levels that a little bit more, right? So those are the conversations we're having on diabetes. Genetic testing is a big one. The Genetic Non-Discrimination Act has been in place for, over 4 years now. Hard to believe. I can tell you that globally, there has been a rapid growth of genetic tests. I think I just saw something in the news this past week about 23andMe. A lot of activity on that front. So I will say that as individuals, the impact of genetics on improvements, Don and I were talking about this a little earlier, improvements on screening, earlier diagnosis, targeted treatments, that's a fantastic thing. From an insurer's perspective, the GNDA, Genetic Non-Discrimination Act, poses a risk because we can't use genetic information. If information is sent to us, we will ignore it. We have to. We can't use it. Unless we have the client's consent. We will underwrite if we have a client's consent. It's just we can't proactively ask for it on all cases. It has to be specific to a case. Anyway, so what we can still do is underwrite family history, and of course for any signs, symptoms, and actual diagnosis of medical conditions. So continue to do that to the extent we can. We are having conversations. I can tell you that there's a group of underwriters, actuaries, and medical consultants that are, we just had a meeting yesterday, having conversations about genetic testing, the impact on the market, especially around family history, just in case, right? Because we're having conversations with the provinces as this, because what we don't want is, one of the challenges with the GNDA when it was passed is that it was very general and broad in its definition. It's fine if we can't use genetic tests that are predictive in nature. We can wrap our heads around that. We have, and we can do that. Where it gets tricky is if it's a genetic test that's not predictive, but it's related to a diagnosis, signs or symptoms, treatment, all of that. That's different in our minds. But the definition is so broad, you can't use it. And so that's why we need to do some work talking to the provinces just to try to position it so that we can still continue to use that information, because it's for the better good of the industry, if you will, to be able to use it. So a little bit of insight on genetics. So it is a hot topic. We'll continue to be happy to provide updates as things happen. I think one of the risks in our market in particular is critical illness. And we see, we just went through a repricing exercise with the reinsurers. This is starting to hit a little bit. Not to the extent that it should, because things right now are good. What we will do is we'll look at our definitions and maybe make some tweaks. I think that you can expect that across the board from insurance companies. Doesn't fix the bigger problem. It helps manage expectations, because we're not taking anything away. We're just clarifying what our intent was with the products. So we're not taking anything away. But over time, I think what you'll see is changes in products, either introducing a new product with maybe reviewable premiums, maybe different levels where we pay out a lot more broadly. It's just you'll have more stages of where you'll pay out. Just gives you a little bit of insight on some of the discussions we're having on critical illness in particular. Smoking. We had an interesting conversation just before we went live about marijuana and smoking, which is an interesting topic in and of itself. But prior to the pandemic, I can tell you that we did see record lows in smoking, generally speaking. But I think more recently, e-cigarettes and vaping in particular, especially in teens, we started seeing escalated risks with that. It was too soon to tell the impact of that, but some trends prior to the pandemic were causing concern, just worth monitoring, let's just say. So we don't know what the long-term impact of that will be, but prior to that, I think there was certainly a lot of, we're trying to look for ways to make smoking not much more of a non-issue, if you will. Again, we were talking just before we went live about occasional smoking and how an occasional smoker's got the same rates as someone who smokes a pack a day and has for their whole lives, right? So yes, we had to draw a line in the sand, and that's what we used for it. We started to be a lot more flexible in that environment. Maybe there's a product structure that we can come up with that says everyone gets non-smoker, and you change it after a period of time. There's a whole bunch of things product-wise that you may be able to do. It's just an interesting topic that we like to talk about because the environment's changed over the years for the better. It's just there's some risks coming in that kind of come into play. Cancer, new screening methods. Liquid biopsy is a big one, right? It's a blood test. So that's one of the reasons we're making changes to our definitions, just to show that for cancers in particular, to do a payout on critical illness, it's based on basically having a pathology report, which is no different than what we do. It's just setting the expectation, because liquid biopsy is a threat in the sense that, and it can't diagnose a cancer. It can tell you how effective you are at treating a cancer based on what's circulating in your bloodstream, but it can't diagnose it yet, but it will come. And so that creates a new risk that we need to be aware of. So we want to make sure that our definition protected us on what the intent was, again, for the critical illness. Opioids, I won't spend a lot of time on this. It was already a global issue. There are reports now showing that COVID has led to increased opioid use and abuse. So we just need to be mindful of the risks that are there. I can tell you that in the insurance market, we can test for opioids, but some of the opioids, the natural opioids, I would say, you can't test for some of the synthetic ones because they change all the time. So we're not sophisticated enough to be able to test for that. So I just mentioned that because sometimes we get lab tests, you could get additional information if you wanted to, but it doesn't protect us to the extent that we thought we think it may. And then just to wrap up, pandemic impacts, again, having long-term view of risks. Talked about this a little bit. I don't think I need to cover it more unless you have any questions, but all worth monitoring. We'll see where things go from here. So next slide, last slide, just where to focus in the future. How do we convert more clients with a smooth and fast application process, real-time decisions? How do we unlock the value of data that we already have? It's true for underwriting, but it's also true for claims management of our in-force block and business. We haven't spent a lot of time and effort on in-force with electronic forms and everything else, or claims, and we need to. So it's one of the conversations we have. It's not all about acquisition, which is great. You get business into the books, but you got to be able to service this business once it's in force. So how do you keep clients engaged and healthy? How do you leverage technology to reduce operating costs for sure, but also unlock untapped potential that we haven't tapped into already? And how do we do all of this? How do we use technology and invest in technology while future-proofing what we're doing? That's one of the things. There's a lot of monitoring on what we're doing. So it's just the reality. It's the new reality of what we do. Before it was just you look at mortality and the experience is pretty good. Now you just need to look at triggers differently and monitor things, because what we're doing now you won't know about for 10 years. So you want to try to future-proof everything you're doing to the best extent that you can. So we don't have all the answers, but I will say that it's a very exciting time to be in new business and underwriting. So I will wrap it up there and maybe turn it over to see if there are any questions.
Yeah, don't have any questions right now, Norm, in the chat or the Q&A, but if you want to send a question, go ahead and send it in that chat box or the Q&A box. But I do have a couple.
Sure.
One of the things that we've seen recently is the exit primarily the exit of long-term care products in Canada. Why do you think that is? And do you see a retooling of that product and a entering into the marketplace of that product?
Yeah, that's a good question. I think you're absolutely right. I think exiting it was because of the nature of the product, the way it stood, the challenges we had supporting it. It was tough to administer. There were a lot of there was a lot at claim time, a lot of challenges, understanding what should be paid, what shouldn't, is it really, and just a lack of general understanding that we needed to kind of address and take a step back. Just to give you some insight, it's a market issue. There's very little interest from the reinsurance market. It's not that there's not interest. It's just I think you're absolutely right. I think it's retooling the product because Dean Chambers and I, and our product actuary, we're talking about it because, especially in our current environment, it's probably more important that we talk about this. So we think there's something there. So it's a conversation we're having. I can't guarantee that we will re-enter into it, but it's certainly a conversation we're all having to see if there's something there.
Now I mean, do have meetings in the US with your compadres down in the US side of things, and they still sell a lot of long-term care product. What do you think that the difference is between the Canadian marketplace and the American marketplace for that product? Is it the belief that our healthcare system is, all we need, and I don't really need the product, or is it a pricing issue, or what
Yeah, a
would be
bit of
the
both.
major issue?
I think a bit of both. I think certainly the market differences play an important factor because in the US, where they don't have the universal health care that we do, maybe there's a sense that it's more of a need there and more acceptance, and so everyone finds a solution where maybe we haven't put the efforts in to do so. So I think it's a challenge for us to tap into for sure.
Some of the carriers here in Canada have gone to a disability product with a long-term care conversion after after the 65 years of
That's
age.
right.
It converts to an LTC type product. Does that hedge your bet in terms of being the underwriting side of it? I mean, you're going to check me out pretty carefully medically in my DI side of things. So by the time I get to the point where I might not have taken care of myself as well as I should have by the time I'm 65, is it easier for the consumer to take that product, cover himself for disability insurance, and then have that long-term care option?
Yeah, I think there certainly is. I think one of the things we do talk about is having more of those type of options available to us on a broader scale, not just with
Right.
disability, but just with other products, and having
Mhm.
options on different product structures that way.
So one of the things that's different in the US and Canada, again, is that we seem to be the only, and you can correct me if I'm wrong, and I might in fact be, but I think we're the last holdout for guaranteed level cost of insurance on universal life, as an example. And even our disability insurance, we've gone to we're primarily a guaranteed type product in that white collar marketplace. Do you see that changing at all? How long can we hold on to these, based on the long-term interest rates going where they've been for the last 10 years? How long can you folks sustain a guaranteed level cost of insurance rather than going what the US has done to that variable universal life version?
Yeah, I think that's probably the top question we've been asking ourselves is we don't see anything imminent happening, but certainly the conversations are happening.
Mhm.
There's so much headwind, and um, it's funny, but this is one of those areas that who's going to be the lead? I think that's one of the biggest drivers of it is once someone goes, I think a lot of people will go, but no one wants to make that first step. Things have worked well. We've got a good structure in place. We know there are headwinds, and you're right. We are I think it's the only market now where we do have this more broadly.
Mhm.
So yeah, to be continued. We're certainly having conversations about it, but nothing imminent
With
at
all
this
the
point.
changes that have gone on with the $5 million limit and the non-face-to-face life insurance and the e-apps and everything else, you'd think that one more thing on top of that pile is probably not a bad thing.
Yeah, it's funny, but one of the things we talk about in, having a big group operation, whether it's critical illness or other type of life products, we're looking at, is there an opportunity to test things in certain ways to see, first of all, are people interested in it? We don't know, right? Another area, and I didn't talk about this a lot, another area is gender. And I'll just be perfectly transparent with you guys. I mean, we're all talking about gender. We know that the UK has gone to gender neutral pricing. Is that a risk in our market? That's one of those things that we're talking about. We're talking about as an industry. We can't collude to all make change together. But because there's no legislation that says we need to, that could come. So we're having the conversations. But is there is there something there? Because we all need to be very conscious, socially conscious of the questions we ask in our application. We can say that our pricing is based on sex at birth. That's fine to say, but there's still a lot of sensitivity around this. So we just need to be mindful of all of that. And I think for us, we're looking at opportunities to either try out a new product that's completely separate, maybe looking at the group area to see if there's something there. One of the big challenges, I'll be perfectly honest, one of the biggest challenges for all the insurers is our legacy systems. You can't test things easily in our environment. It's so expensive, and it just makes a business case look awful when you try it when you need to make system changes. That's just a matter. That's just business, right? So the more we can test and learn and find out if there's an opportunity, I think that's when you'll start seeing some shifts.
Got a question here from somebody saying, most of my clients who are clinical counselors use mental health professionals themselves due to the nature of the work that they do, obviously. How does the company view this usage of mental health services in underwriting?
Yeah, that's one of those things that that should not affect the risk whatsoever. I think, whether it's regular follow-ups or like that's all, in my opinion, still covered under standard risks for any product that we have. So generally speaking, where we really get into more severe forms of mental illness is just when it really does impact significantly a person's ability to perform, I'll say, their usual duties, whatever the case may be. Very few of those cases actually happen. The other thing that could trigger is just the recency of something. If someone hasn't had insurance for a long period of time and all of a sudden they're applying shortly after, that just raises red flags. But it doesn't mean the person's not uninsurable. But those are the two situations: recency or something that's very severe. Otherwise, if it's just I'll call it regular maintenance, regular follow-ups, that should not impact a person's ability to get insurance.
I think it goes back to your cover letter as well, right? More clearly defining or describing in the cover letter why they're seeing a counselor, because it'll ask, have you seen any counselor or other medical practitioner in the last 12 months? And it's yes, I've gone to counseling. Well, why? And then if you clearly describe that in the cover letter, that might be a help.
Exactly.
That leads me to another question. One is actually one related to what I thought of earlier, and one that's come up is from someone in the field, is that it seems like with all this automatic underwriting, that the subtleties of underwriting are being lost a little bit, or the art of underwriting, where your underwriters have the discretionary power to say, yeah, this is where it is, but understanding the conversation with the advisor, here's where we have a business case to go this way rather than that way. How far away are we from losing the subtleties of that underwriting decision?
Yeah, that's a great question. I don't think that's going to happen. I mean, it may happen a little bit here and there, but generally speaking, when we build our rules for automation, we don't build it to be conservative, right? So what I mean by that is, sometimes you're looking at something and you would expect to have A, B, C, D. Well, we don't ask A, B, C, D. We'll ask A and B, and if it's fine, then you go. If it doesn't fit in that, then the underwriter needs to look at it. That's where that underwriting discretion comes into play. And I'll be honest, I think for the last 10, 15 years, when we've had this automated, underwriting rules engine and it kicks out for this reason, one of the risks we had over time is underwriters got very familiar with that one reason. They didn't look at the bigger picture. So we're trying to your point, whether it's through a cover letter or just having the underwriter take a step back, automate what you can, whatever isn't, that you need to find solutions, not put roadblocks in place, find solutions. So
Yeah, I think that, one of the other part of this question was, where can I access that digital underwriting tool? And it always, again, we need access to that digital underwriting tool, obviously, and it's on your website and we can find it. But I'm always suspect of that digital underwriting tool because of what you just said. There's parameters, blood pressure, height and weight. There's some guidelines there. And then, well, in this situation, they've lost 15 pounds because, or they've got a Peloton recently and they're doing this. Like, there's more to it than just black and white. Where
yeah,
can I go and learn more about rather than pushing it aside and not getting involved, or maybe I should not worry about it? Where can I learn more about field underwriting? Because we've even gone away from asking the part two. You know, if I know a paramed nurse is coming in to do the part, or a teleoperator is doing the med, I'm not asking part two. But I'm stuck back. I'm too old, I guess, because I'm stuck back in the day where I want to kind of know the answers to part two, because I need to know what direction I'm headed with this individual. As you know, some companies offer the Astra program or a different level of underwriting if the person's rated or shopping or everything else.
Yep.
And I want to know that up front, as opposed to at the back end where it came back rated 300%. I go, geez, now we got to shop it. I wish I'd known why. You know, they had 3 strikes against them. They had blood pressure, height, and weight, and they're almost diabetic. Where can I go learn, if I want to, more about underwriting?
That's a good question, because we're actually having conversations about what should we, because to be honest with you, we had a field underwriting guide several years ago that we developed, but I think we kind of put it aside and didn't expand on it. I think we have been having conversations about, and some companies are good at it. Some companies have a section on their website that focuses on underwriting. You can kind of go in and find some information. We want to build that as well. I think there's an opportunity, to your point, to provide you with more field underwriting information. So it's a good takeaway for me. I don't have the answer for you now, but I think it is something we've talked about. So I'm happy to hear that maybe you're interested in having that as well.
Yeah, I think the newer advisors don't get, I mean, you know, they weren't trained by a career agency system. So they weren't really trained in the subtleties of underwriting. With, you know, we'd have people like you come in once a month and talk about underwriting. It wasn't a webinar, but they in the office or go around the country and do the subtleties of field underwriting. You actually are licensed as a field underwriter, as a
Yes.
representative of the company, right? Now I represent multiple companies, and each one has a different underwriting guide, and I leave it to my paramedical nurse to do it. You know, I just ask the part one, and part two, it's somebody else takes care of it. Or now with you guys, up to $5 million, nothing.
Yeah. I will tell you that Stefan and myself, we've been talking, we may create a field underwriting, it won't be called that, but it'll be essentially a field underwriting team that'll be closer to the sales process than the operations. So
Right.
kind of a bridging the gap, something we've been talking about doing.
Mhm.
Yeah.
Okay, I'm just looking at Sun Life is not caring for long-term care insurance. I'm just looking at something here. I'm just looking at the questions. Now that the digital underwriting tool, where would I find that on your website?
I can send you,
The address? Okay, good. Then
yeah.
I can just forward that to the attendees.
Okay.
That's all the questions we have, Norm, for today. So
Awesome.
I'm just looking at my list. Is there anything else? No, medical questions. Should I bother? Oh, I got one that always drives us crazy in the field. What suggestion would you have to expedite a doctor to get that APS in your
Oh,
hands
geez.
quicker?
That's a great question. Honestly, you have the most success at getting the information usually, and well, actually the client does.
Yeah.
You know, that's the person has the most influence, it seems. We're looking for opportunities. I mean, I know we don't have digital health records, but we are in conversations, as are other insurers, with vendors that will focus in this area, that we hope will start bringing new solutions to the market. It won't be immediate. It will be a long journey, but at least it's tapping into probably the one area that has had the least focus or at least impact over the years, right? APSs are always time consuming. It takes 40 days on average to get in. It's crazy. So is there a way to improve that process through someone doing follow-ups for us? Because we do have a vendor that we use to get our APSs for us, and they do follow-ups, regular follow-ups on cycles. But it's almost like that's been in place too long now that people ignore it. So we got to find a different solution, right? So those are some of the things we're looking at.
Yeah, I think one of the criticisms of that system is that, you know, it's my week later follow-up, and as long as I send an email off saying I followed up, I followed up.
Exactly.
It's
Yeah.
not really follow through on the follow-up. It's just a follow-up saying that you did your job, right? So it
Yeah.
gets a little dangerous there, and things go on for a longer period of time. But speaking of a longer period of time, we're over 2 o'clock. I wanted to really thank you today, Norm, for this presentation, and I can see why now you've been inducted into the Hall of Fame. It was a great
Thanks,
job.
Don.
Hopefully we see you again soon on a more focused opportunity. So we'll get in touch with you again to do something for us in the near future. But thanks very much for your help.
No problem. Thanks for having me.